All right, reading 40. We are now getting into part 2 of the portfolio risk and return section. Reading 40, learning outcomes. The candidate should be able to describe the implications of combining a risk-free asset with a portfolio of risk assets. Explain the capital allocation line, the CAL, and the capital market line, the CML. And explain systematic and non-systematic risk, including why an investor should not expect to receive additional returns for bearing non-systematic risk. Explain returns generating models and their uses. Calculate and interpret beta. Ooh, sounds very mysterious. So what's beta going to represent this time? Yeah. Explain the capital asset pricing model, including its assumptions and a security market line. Calculate and interpret the expected returns of an asset using the CAPM. Describe and demonstrate applications of the CAPM in the SML. Calculate and interpret the Sharpe ratio, the Trenner ratio, the M square, and the Jensen's alpha. Okay. Introduction. Our objective in this reading is to identify the optimal risky portfolio for all investors by using the capital asset pricing model, the CAPM. The foundations of this reading is the computation of risk and return of the portfolio and the role the correlation plays in diversifying portfolio risk and arriving at efficient frontier. The efficient frontier and the capital allocation line consists of portfolios that are generally acceptable to all investors. But combining an investor's individual indifference curves with the market-determined capital allocation line, we're able to illustrate that the only optimal risky portfolio for an investor is the portfolio of all risky assets, i.e. the market. Additionally, we discussed the capital market line, a special case of the capital allocation line that is used for passive investor portfolios. We also differentiate between systematic and non-systematic risk and explain why investors are compensated for bearing systematic risk, but receive no compensation for bearing non-systematic risk. We discuss in detail the CAPM, which is a simple model for estimating asset returns based on only the asset systematic risk. Finally, we illustrate how the CAPM allows a security selection to build an optimal portfolio for an investor by changing the asset mix beyond a passive market portfolio. This reading is organized as follows. Section 2, we discuss the consequences of combining a risk-free asset with a market portfolio and provide an interpretation of a capital market line. Section 3 decomposes total risk into systematic and non-systematic risk and discusses the characteristics of the differences between the two kinds of risk. We also introduce return generating methods, including the single index model, and illustrates the calculations of beta by using formulas and graphically by using security characteristic lines. In section 4, we introduce the capital asset pricing model and the security making line. We discuss many applications of CAPM and SML throughout the reading, including the use of expected returns in market capital budgeting decisions and evaluation of portfolios using the CAPM risk-adjusted returns as the benchmark, security selection, and determining whether adding a new security to the current portfolio is appropriate. Our focus on the CAPM does not suggest that CAPM is the only very viable asset pricing model, although the CAPM is an excellent starting point. More advanced reading expands on the discussion and extends the analysis to other models that accounts for multiple explanatory factors. A preview of numbers of these models is given in section 5, and a summary of the practice problems concludes the reading. Capital market theory. You have learned how to combine a risk-free asset with a risky asset and with many risky assets to create a capital allocation line. In this section, we expand our discussion to multiple risky assets to consider a special case of the capital allocation line called the capital market line. While discussing the capital market line, we will define the market and its role in passive portfolio management. Using those concepts, we will illustrate how leveraged portfolios can enhance both risk and return. Portfolio of risk-free and risky assets. Although investors desire an asset that produces the high return and carries the lowest risk, such as assets does not exist. As the risk-return capital market theory illustrates, one must assume a higher risk in order to earn a higher return. We can improve an investor's portfolio, however, by expanding the opportunity set of risky assets, because this allows the investors to choose superior mixes of assets. Similarly, an investor's portfolio improves if a risk-free asset is added to the mix. In other words, combining a risk-free asset with a risky asset can result in a better risk-return trade-off than an investment that only one type of asset, because the risk-free asset has zero correlation with the risky asset. The combination is called the capital allocation line. So, superimposition of investors' indifference curves on the capital allocation line will lead to the optimal investor's portfolio. Investors with different levels of risk aversion will choose different portfolios. High risk adverse investors choose to invest most of their wealth in risk-free assets and earn low returns because they are not willing to assume higher levels of risk. Less risk-adverse investors, in contrast, invest in more of their wealth in risky asset, which is expected to yield higher returns. Obviously, the higher returns cannot come without higher risk, but the less risk-adverse investor will accept the additional risk, combining risk-free assets with a portfolio of risky assets. When we can extend the analysis of a risky asset to a portfolio of risky assets. For convenience, assume that the portfolio contains all available risky assets, although an investor may not wish to include all of these assets in the portfolio because of the investor's specific preferences. In an asset, if asset is not included in the portfolio, the weight will be zero. The risk-return characteristic of the portfolio of n risky assets will give by the following equations. The expected returns on the portfolio is the weighted average of the expected returns of individual assets, where WI is the fractional weight of the asset I and R, and expected return assets of I, the risk of the portfolio, however, depends on the weights of the individual assets, the weights of the individual assets, and their interrelationships, the covariance between assets I and J. The cov ij is the statistical measure of the interrelationship between each pair of assets in a portfolio and can be expressed as follows, where this is the correlation between assets I and J, and the standard deviation of I is the risky asset of I. Expressed as follows. Note that the equation below, that the correlation of an asset with itself is 1. Therefore, this is true. By substituting the above expression with covariance, we could rewrite the portfolio variance as such. The suggestion that portfolio has lower risk than the asset then contains may have counterintuitive. These portfolios can be constructed, however, as long as the asset and the portfolio are not perfectly correlated. As an illustration of the effect of asset weights on portfolio characteristics, consider a simple 2-asset portfolios with 0 weights in all other assets. Assume that asset 1 has a return of 10% and a standard deviation or risk of 20%. Asset 2 has a return of 5% and a standard deviation risk of 10%. Furthermore, the correlation between the two assets is 0. Exhibit 1 shows risk and return for portfolio X and a weight of 25% in asset 1, 75% in asset 2, portfolio Y, and a weight of 50% for each of the two assets, portfolio Z, and a weight of 75% in asset 1, 25% in asset 2. Okay, look at this example. For this example, we can observe that 3 portfolios are quite different in terms of their risk and return. Portfolio X has a 6.25% return and only 9.01% standard deviation, whereas the standard deviation of portfolio Z is more than 2 thirds higher at 15.21%, although the return is only slightly more than 1/3 higher, 8.75%. The portfolio may become even more dissimilar as other assets are added to the mix. Consider 3 portfolios of risky assets A, B, and C as in Exhibit 2. That may have been presented to a representative investor by 3 different investment advisors. Each portfolio is combined with the risk-free asset to create 3 capital allocation lines, Cal 1, Cal A, Cal B, Cal C. The exhibit shows portfolio C is superior to the other portfolios because it has a greater expected return for any given level of risk. As a result, the investor will choose the portfolio that lies on the capital allocation line. For portfolio C, the combination of risk-free assets and a risky portfolio C that is selected for all investors depends on the investor's degree of risk aversion. Does a unique optimal portfolio, a risky portfolio exist? We assume that all investors have the same economic expectation and thus have the same expectations of price, cash flow, and other investment characteristics. This assumption is referred to as the homogeneity of expectations. Given these investment characteristics, everyone goes through the same calculations and should arrive at the same optimal risky portfolio. Therefore, assuming homogeneous expectations, only one optimal portfolio exists if investors have different expectations. However, they might arrive at different optimal risky portfolios. To illustrate, we begin with an expression of the price of an asset. So that's the expression of the price of an asset. We use the formula of the price of an asset to estimate the intrinsic value of an asset. For ease of reference, assume that the asset we are valuing in share of HSBC Holdings, parent of HSBC Bank, a British company that also trades on the Hong Kong Stock Exchange. In the case of corporate stocks, there is no expiration date, so T can be extremely large, meaning we will need to estimate a large number of cash flows in return, rates of return. Fortunately, the denominator reduces the importance of distant cash flows, so it may be sufficient to estimate, say, 20 annual cash flows and 20 rates of returns. How much will HSBC earn next year and the next year after? What will the bank sector look like in 5 years' time? Different analysts and investors will have their own estimates that may that may be quite different from one another. Also, as we devolve further into the future, more serious issues in estimating future revenues, expenses, and growth rates arise. Therefore, to assume the cash flow estimates for HSBC will vary among these investors, it is reasonable, in addition to the numerator or cash flow, it is also necessary to estimate a denominator, the required rates of return. We know the riskier companies will require higher returns because risk and return are positively correlated. HSBC stock is risky than risk-free assets, but by how much? As we should the compensation for additional risk begin. Again, it is evident that the different analysts will view the riskiness of HSBC differently and therefore arrive at different requested rates of return. HSBC closed at Hong Kong dollars of 89.40 on 31st of December 2009 on the Hong Kong Stock Exchange, and traded price represents the value of the marginal investors attached to the shares of HSBC, C corresponding to the analyst A expectations. Analyst B may think that the price of should be Hong Kong $50. However, analyst C may think it should be Hong Kong $150. Given correct price of Hong Kong $89 as expected return of HSBC are quite different. For 3 analysts, analyst B believes the price of so it's overvalued, undervalued, and fairly valued according to different calculations. Our discussion illustrates that analysts can arrive at different variations that necessitates the assignment of different asset weights in the portfolio. Given the existence of many asset classes and numerous assets in each asset classes, one could visualize each investor will have his or her own optimal portfolio depending on his or her assumptions underlying the valuation computation. Therefore, market participants will have their own possibly different optimal risky portfolios. If investors have different valuations of assets, then the construction of a unique optimal risky portfolio is not possible if we make a simplifying assumption of homogeneity and investor expectations. We'll have a single optimal risky portfolio. As previously mentioned, even if investors have different expectations, market prices and are a proxy of which the marginal informed investor expects, and the market portfolio becomes the base case, the benchmark, or the reference portfolio that other portfolios can be judged against. For HSBC, the market price of $89.4 Hong Kong dollars per share, the market capitalization of Hong Kong 1.8 trillion. In constructing the market portfolio, HSBC's weight in the market portfolio will be equal to the market value divided by the value of all other assets, including the market portfolio. The capital market line. In the previous section, we discussed how risk-free assets can be combined with a risky asset portfolio to create a capital allocation line. In this section, we discuss the specific CAL that uses the market portfolio as the optimal risky portfolio and is known as the capital market line. We also discussed the significance of the market portfolio and applications of the capital market line, passive and active portfolios. In the above subsection, we arrive at 3 possible valuations for each share of HSBC: Hong Kong 50, Hong Kong 89.4, Hong Kong 150, which is correct. If the market is formed an informationally efficient market, the price in the market Hong Kong 89.4 is the unbiased estimate of all future discounted cash flows. In other words, the price aggregate reflects all information that is publicly available, and investors cannot expect to earn a return that is greater than the required rate of return for asset. If, however, the price reflects all publicly available information, and there is no way to outperform the market, then there is little point in investing time and money in evaluating HSBC to arrive at your price using your own estimates of cash flows and rates of return. In this case, a simple and convenient approach to investing is to rely on the prices set by the market. Portfolios that are based on assumptions of unbiased market prices, also referred to as passive portfolios. Passive portfolios most commonly replicate the track market index, which can possibly construct on the basis of market prices and market capitalization. Examples of market indexes are the S&P 500 index and the Nikkei 300 index and the CAC 400. Passive portfolios based on market indexes are called index funds and generally have low cost because no significant effort is expended on the various securities, and they are included in the index. In contrast, passive investors' reliance on market prices, and index funds acting investors may not rely on the market valuations. They have more confidence in their own ability to estimate cash flows, growth rates, and discount rates. Based on the estimates, they value assets and determine whether the asset is fairly valued. In an actively managed portfolio, assets and their overvalued have a chance of offering above normal returns. We have a positive rate, whereas other assets will have a zero weight or even a negative weight if short selling is permitted. This style of investing is called the active investment management, and the portfolios are referred to as active portfolios. Most open-end mutual funds and hedge funds practice active investment management, and most analysts believe that active investing adds value, whether the analyst is right or wrong, the subject of continuing debate. What is the market? In the previous discussion, we referred to the market on numerous examples. Without actually defining the market, the optimal risky portfolio and the capital market line depends on the definition of the market. So what is the market? Theoretically, the market includes all risky assets or anything that has value, which includes stocks, bonds, real estate, and even human capital. Not all assets are tradable, however, and not all tradable assets are investable. For example, Taj Mahal in India is an asset, but it is not tradable asset. Similarly, human capital is an asset that is not tradable. Moreover, assets may be tradable but not investable. Because of if we consider all stocks, bonds, real estate assets, commodities, etc., probably hundreds and thousands of assets are traded and investable. The market should contain as many assets as possible. We emphasize the word possible because not all practical to include all assets in a single risky portfolio. Even though advances in technology and interconnected markets have made much more easier to span major equity markets, we're still not able to easily invest in other assets like bonds or real estate except in most developed countries. For the rest of this reading, we will define market quite narrowly because it is practical and convenient to do so. Typically, the local and regional stock market index is used as the proxy for the market because of active trading in stocks and because a local regional market is the most visible of the local investors. For all purposes, we will use the S&P 500 index as the market's proxy. So S&P 500 is commonly used by analysts as a benchmark of the market performance throughout the U.S. It contains 500 of the largest stocks that in the United States, and the stocks are weighted by the market capitalization. The stock in the S&P 500 accounts for approximately 80% of total equity market capitalization in the U.S. and becomes the U.S. stock market represents about 32% of the world markets. The S&P 500 represents roughly 25% of the world publicly traded equity. Our definition of the market does not include non-U.S. Stock markets, bond markets, real estate, or many other asset classes, and therefore market returns and market risk premiums refer to U.S. equity returns and the U.S. equity risk premium, respectively. The use of this proxy, however, is significant in our discussion. And is relatively easy to expand to include other tradable assets. The capital market line is CML. Capital allocation and line include all possible combinations of the risk-free assets and investors' optimal risk portfolio. The capital market line is a special case of the capital allocation line, where the risk portfolio is the market portfolio. The risk-free asset is a debt security with no default risk, no inflation risk, no liquidity risk, no interest rate risk, and no risk on any other kind. U.S. Treasury bills are usually used as a proxy of the risk-free return. The S&P 500 is a proxy of the market portfolios, where it is an optimal risky portfolio. Therefore, the expected return on the risky portfolio is the expected market return expressing as ERM. The capital market line is shown in Exhibit 3, where the standard deviation of total risk is the x-axis, and the expected portfolio return is the y-axis. Graphically, the market portfolio is the point at the Markowitz effect frontier. All points interior to the Markowitz effect frontier are inefficient portfolios that provide the same level of return at higher levels of risk or lower levels of return, which is the same amount of the risk. When plotted together, the point at which the CML is targets as tangent to the Markowitz efficient frontier is the optimal combination of risky assets on the basis of market prices and market capitalization. The risky portfolio is the market portfolio. The CML intercept on the y-axis is the risk-free return. Because that is the return associated with zero risk, the CML passes through the point represented by the market return with respect to capital market theory. Any point above the CML is not achievable. At any point below CML dominates, but inferior to any point on the CML. Notes that we identify the CML and CAL as lines lines even through they can be combinations of two assets, unlike a combination of two risky assets, which is usually not a straight line. A combination of risk-free assets and a risky portfolio is a straight line, as illustrated below by computing the combinations risk and return. Risk and return characteristics of the portfolio represented by the CML can be computed by using the returns and risk expression for two asset portfolios. The proportions invested in risk-free assets is given by W1, and the balance is invested in the market portfolio is 1 minus W1. The risk of the risk-free asset is given by the symbol, the risk of the market. Yeah, so this is just interpreting this formula. By definition, the standard deviation of the risk-free asset is 0. Because its risk is 0, the risk-free asset does not covary or move with any other asset. Therefore, its covariance with all other assets, including the market portfolios, is 0, making the first and third term under the squared root sign 0. As a result, the portfolio returns and portfolio standard deviation can be simplified and written as such. Leverage the portfolios in the previous example. Mr. Miles evaluated an investment of between 0% and 100% of the market and the balance of T-bills. The line connecting the RF and M, the market portfolio, in Exhibit 4 illustrates these portfolios with respect to levels of investment. At RF, an investor is investing all of his or her wealth into risk-free securities, which is equivalent to lending 100% at the risk-free rate. At point M, he or she is holding the market portfolio and not lending any money at the risk-free rate. The combination of risk-free assets and the market portfolio, which may be achieved by points between those two limits, are the term of lending portfolios. In effect, the investor is lending part of his or her wealth to the risk-free rate. If Mr. Miles is willing to take more risk, he may be able to move to the right of the market portfolio by borrowing money and purchasing more of portfolio M, assuming that he is able to borrow at the same risk-free rate of interest, RF, at which he can invest. He can then supplement his available wealth with borrowed money and construct a borrowing portfolio. If the straight line of joining RF and M is extended to the right of point M, this extended section of the line represents borrowing portfolios. As one moves further to the right of point M, an increasing amount of borrowed money is being invested in the market. This means that there is negative investment in the risk-free asset, which is referred to as a leveraged position, in the risky portfolio. The particular point chosen on the CML will depend on the individual's utility function, which in turn will be determined by their risk and return preferences. So it's a trade-off between risk and return. Leverage portfolios and different lending and borrowing rates. Although we assume that Mr. Miles will borrow at the same rate of U.S. government, it is more likely that he would have to pay a higher rate than the government because because his ability to repay is not as certain as the government's. Now consider that although Mr. Miles can invest or lend at RF, he will have to borrow at RB, a rate that is higher than the risk-free rate. And that once again is a line that the higher the risk, the more return you have to get, and the lower the risk, the less return you would get. The first equation is for the line where the investment in the risk-free asset is 0, or positive, that is at M, or to the left of M in Exhibit 5. The second equation is for the lines where we're borrowing or negative investments in the risk-free assets occurs. Note the only difference between two equations in the interest rates used for borrowing and lending. All passive portfolios will lie on the kinked CML, although the investment in the risk-free assets may be positive lending. 0, no lending or borrowing, or negative or borrowing. Leverage allows risk-adverse investors to increase the amount of risk they take by borrowing money and investing more than 100% in the passive portfolio. Pricing of risk and computation of expected returns. In constructing a portfolio, it is important to understand the concept of correlation and how less than perfect correlation can diversify the risk of a portfolio. As a consequence, the risk of an asset held alone may be greater than the risk of the same asset when it is part of a portfolio, because the risk of an asset varies from one environment to another. Which kinds of risk should an investor consider, and how should the risk be priced? This section addresses the question by pricing of risk and decomposing the total risk of a security or a portfolio into systematic and non-systematic risk, the meaning of these risks and how they are computed, and the relevance and the pricing and assets are also discussed. Systematic risk and non-systematic risk. Systematic risk, also known as non-diversifiable risk or market risk, is a risk that affects the entire market or economy. In contrast, non-systematic risk is risk that pertains to a single company or industry, that is also known to be a company-specific or industry-specific, diversifiable, or an idiosyncratic risk. Systematic risk is risks that cannot be avoided and is inherent in the overall market. It is non-diversifiable because it includes risk factors that are innate within the market and affects the market as a whole. Examples of factors that constitute systematic risk includes interest rates, inflation, economic cycles, political uncertainty, and widespread natural disasters. These events affect the entire market, and there is no way to avoid their effect. Systematic risk can be magnified through a selection by using leverage, or diminishing by including securities that have a low correlation with the portfolio, assuming that they are not already part of a portfolio. Non-systematic risk is a risk that is local or limited to a particular asset or industry that needs that need not affect assets under the asset class. Examples of non-systematic risk could include a failure of drug trials, major oil discoveries, or an airliner crash. All of these events will directly affect the respective company and even possibly industries, but have no effect on assets that are far removed from these industries. Investors capable of avoiding non-systematic risk through diversification by forming a portfolio of assets that are not highly correlated with one another. We will derive expressions for each kind of risk later in this reading. We will see that the sum of systematic variance and non-systematic variance equals the total variance of the security or portfolio. The total variance is equal to systematic risk plus systematic variance plus non-systematic variance. Although the equality relationship is between variance, you will find frequent references to total risk as a sum of systematic risk and non-systematic risk. In those cases, the statement refers to variance, not standard deviation. Pricing of risk. Pricing or valuing an asset is equivalent to estimating its expected rate of return. If an asset is known to terminal value, such as the face value of a bond, then a lower current price implies a higher future return, and a higher current price implies a lower future return. The relationship between price and return can also be observed in the valuation expressed in section 2.1.2. Therefore, we'll occasionally use price and return interchangeably when discussing the price of a risk. Consider the asset with both systematic and non-systematic risk. Assume that both kinds of risk are priced. That is, you receive a return for you return for both systematic risk and non-systematic risk. What will you do? Realizing that non-systematic risk can be diversified away, you will buy assets that have a large amount of non-systematic risk. Once you have bought those assets with non-systematic risk, you will diversify or reduce the risk by including other assets that are not highly correlated. In this process, you will minimize non-systematic risk and eventually eliminate it altogether from your portfolio. Now you will have a diversified portfolio with only systematic risk, yet you will be compensated for non-systematic risk that you no longer have. Just like everyone else, you would have an incentive to take on more and more diversifiable risk because you are compensated for it, even though you can get rid of it. The demand for diversifiable risk will keep increasing until the price becomes infinite and the expected returns falls to zero. This means that our initial assumptions of a non-zero return of diversifiable risk was incorrect, and that the correct assumption is zero return for diversifiable risk. Therefore, we could assume that if in a efficient market, non-incremental rewards can be earned by taking in diversifiable risk. In the previous exercise, we illustrate why investors should not be compensated for taking on non-systematic risk. Therefore, investors who have non-systematic risk must diversify in a way by investing in many industries, or many countries, and many asset classes because future returns are unknown and it is not possible to pick only winners. Diversification helps in offsetting poor returns in one asset class by garnering good returns in other asset classes, thereby reducing the overall risk of the portfolio. In contrast, investors must be compensated for accepting systematic risk because that investors cannot be diversified away. If investors do not receive a return commensurate with the amount of systematic risk they are taking, they will refuse to accept systematic risk. In summary, systematic or non-diversifiable risk is priced, and investors are compensated for holding assets or portfolios based only on that investment's systematic risk. Investors do not receive any return for accepting non-systematic or diversifiable risks. Therefore, it is in the interest of risk-adverse investors to hold only well-diversified portfolios. Calculating and interpretation of beta. As previously mentioned, in order to form the market portfolio, you should combine all available risky assets. Knowledge of the correlations among these assets allow us to estimate portfolio risk. You also learn that a fully diversified portfolio will include all asset classes and essentially all assets in the asset classes. The work required for construction of the market portfolio is formidable. For example, for a portfolio of 1,000 assets, we need 1,000 returns estimate, 1,000 standard deviation estimates. As such, correlations, other related questions that arise when this analysis are whether we really need all 1,000 assets and what happens if there are errors in these estimates. An alternative method of constructing an optimal portfolio is simpler and easier to implement. An investor begins with the known portfolio, such as the S&P 500, and then adds other assets one at a time on the basis of the asset's standard deviation, expected return, and impact on the portfolio's risk and return. This process continues until the addition of another asset does not have a significant impact on the performance of these portfolios. The process requires only estimates of systematic risk and each asset because investors will not be compensated for non-systematic risk. Expected returns can be calculated by using return-generated models, as well as we will discuss in the section. In addition to using return-generating models, we will also decompose the total variance into systematic variance and non-systematic variance and establish a formal relationship between systematic risk and return. In the next section, we will expand on the discussion and introduce the CAPM as the preferred return-generating model. Return-generating model is a model that can provide an estimate of the expected return of a security given certain parameters. If systematic risk is the only relevant parameter for return, then a return-generating model will estimate the expected returns for any asset that gives a level to systematic risk. As with any model, the equity of estimates of expected returns will depend on the equity of input estimates and the accuracy of the model, because it is difficult to decide which factors are appropriate for generating returns. The most general form of a return generating model is a multi-factor model. A multi-factor model allows more than one variable to be considered in estimating returns and can be built using different kinds of factors, such as macroeconomic, fundamental, and statistical factors. Macroeconomic factors use economic factors that are correlated with security returns. These factors may include economic growth, the interest rates, the inflation rates, productivity, employment, and consumer confidence per past relationships with returns and estimates to attain parameter estimates, which are in turn used for computing expected returns. Fundamental factor models analyze the use of relationships between security returns and the company's underlying fundamentals, such as, for example, earnings growth, cash flow generation, investment, research, advertising, and number of patents. Finally, a statistical factor model, historical and cross-sectional return data are analyzed to identify factors that explain variance or covariance in observed returns. These statistical factors, however, may or may not have an economic or fundamental connection to returns. For example, the conference to which the American football Super Bowl winner belongs, whether the U.S. stock return, whether the American Football Conference or the National Football Conference may a factor in U.S. stock returns, but not obviously economic connections seems to exist between the winners conference and U.S. stock returns. Moreover, data mining may generate more spurious factors that are devoid of any economic meaning. Because these limitations, analysts prefers the macroeconomic and fundamental factor models for specifying and estimating return generating models. Return generating models expressed as follows: 3 factors and 4 factor models. Eugene Fama and Kenneth French suggested that a return generating model for stock returns should include relative size of the company and relative book to market value of a company in addition to beta. Fama and French found the past returns could be explained better with their models than with other models available at the time, most notably the capital asset pricing model. Mark Carhart extended the Fama and French models by adding another factor, a momentum defined as the relative past stock returns. We'll discuss the model further in 5.3.2. A single index model, the simplest form of return generating model, is a single factor linear model in which only one factor is considered. The most common implementation is a single index model, which uses the market factor in the following forms. Another is a single index model. It's simple, it fits nicely with the capital market line. Recall that CML is linear with an intercept of RF and a slope of such. We could rewrite CML by moving the intercept to the left-hand side of the equation, rearranging in terms and generalizing the subscript from P to I for the security as such. Decomposition of total risk for a single security, a single index model. With the introduction of return generating models, particularly the single index model, we are able to decompose total variance into systematic and non-systematic variance. Instead of using expected returns in a single index, let us use realized returns. The indifference between expected returns and realized returns is attributable to non-market changes as an error terms EI, the second equation below. The variance of realized returns can be expressed as the equation below. We can further drop the covariance terms in the equation because by definition, any non-market returns is uncorrelated with the market. Thus, we are able to decompose total variance into systematic and non-systematic variance in the second equation. Because non-systematic risk is 0 for well-defined portfolios such as the market portfolio, the total risk of market portfolios and other similar portfolios is only systematic risk, which we can now return the CML discussed in the previous subsection and replace because CML assumes that the market is a diversified portfolio, by making this substitution for the above equation, we get the following single index model. Return generating models, the market model. The most common implementation of a single index model is the market model, in which the market return is a single factor or a single index. In principle, the market model and the single index model are similar. The difference is that the market model is easier to work with and is normally used for estimating beta risk and computing normal returns. The market model is as such. Okay. As shown in the above equation, beta is a measure of how sensitive an asset's returns is to the market as a whole, and is calculated by the covariance of the returns of I and the returns on the market divided by the variance of the market return. That expression is equivalent to the product of the asset's correlation with the market with the ratio of standard deviation of returns. As we have shown, beta captures the asset systematic risk, or the proportions of an asset risk cannot be eliminated by diversification. The variance and correlation it requires for the calculations of beta, and usually based on historical returns. A positive beta indicates that the returns of an asset follows the general market trend, whereas a negative beta shows that a return of an asset generally follows a trend that is opposite to that of the market. In other words, a positive beta indicates that the returns of an asset moves in the same direction of the market, whereas a negative beta indicates that the returns of an asset moves in the opposite direction of the market. Okay. Estimation of beta. An alternative is a more practical approach is to estimate beta directly by using the market model described above. The market model as such is estimated by using regression analysis, which is the statistical process that evaluates the relationship between a given variable and one or more other variables. Historical security returns and historical market returns are inputs used for estimating the two parameters of alpha I and beta I. Regression analysis is similar in plotting all contributions of the asset's returns and the market returns of Ri, Rm, and then drawing a line through all points such that to minimize the sum of squared linear deviations in the form of a line. Exhibit 6 illustrates the market model and estimates parameters and intercept A and the slope term B, or beta, alpha and beta, and all that is needed to define the security characteristic line and obtain beta estimates. Although beta estimates are important for forecasting future levels of risk, there is much concern about their accuracy. In general, shorter periods of estimation represents beta that is closer to the asset's current level of systematic risk. Shorter periods of beta estimates, however, are also less accurate than beta estimates measured over 3 to 5 years, because they may be affected by some special events in this short period. Although longer period beta estimates are more accurate, they may be a poor representation of future expectations. Estimates are more accurate. They may be a poor representation of future expectations, especially if major changes in assets have occurred. Therefore, it is not necessary to recognize the estimates of beta, whether obtained through calculations of regression analysis, may or may not represent current or future levels of an asset's systematic risk. Beta and expected returns, although the single index model, also called the capital asset pricing model, will be discussed in greater detail in the next section. We will use the CAPM in this section to estimate returns given asset betas. The CAPM is usually written with the risk-free rate on the right-hand side. The model shows that the primary determinant of expected returns for a security is its beta, or how well the security correlates with the market. The higher the beta of an asset, the higher its expected return will be. Assets with a beta greater than 1 have an expected returns that is higher than the market returns, whereas assets with a beta less than 1 have an expected returns that is less than the market return. In certain cases, assets may require a return less than free risk-free returns. For example, if an asset's beta is negative, the required return will be less than the risk-free return. When combined with the market, an asset reduces the risk of the overall portfolio, which makes the asset very valuable. Insurances is one such asset. Insurance gives the positive return when the insured's wealth is reduced because of a catastrophic loss. It is in the absence of such a loss, or when the insured's wealth is growing, the insured is required to pay an insurance premium. Thus, insurance has a negative beta and a negative expected returns, but helps in reducing overall risk. Capital asset pricing model. The capital asset pricing model is one of the most significant innovations in portfolio theory. The model is simple yet powerful. It's intuitive yet profound, and uses only one factor, yet is broadly applicable. The CAPM is introduced independently by William Sharpe, John Lintner, Jack Trainer, and John Mosine, and builds on Harry Markowitz's earlier work on diversification and the modern portfolio theory. The model provides a linear expected return beta relationship and precisely determines the expected returns given the beta of an asset. In doing so, it makes the transition from total risk to systemic risk and primarily determinant of expected return. Recall the following equation. The CAPM asserts that the expected return of assets vary only by their systematic risk as a measure of beta. Two assets with the same beta will have the same expected return irrespective of nature of those assets. Given the relationship between risk and return, all assets are defined only by their beta. Risk, which we will explain as an assumption as described, and the remainder of the section will examine the assumptions made in arriving at CAPM and the limitations of these assumptions entailed. Second, we will implement the CAPM through the security market line and price any portfolio or asset, both efficient and inefficient. Finally, we will discuss ways in which the CAPM can be applied to investments, valuation, and capital budgeting. Assumptions of CAPM. Similar to other models, CAPM ignores many of the complexities of financial markets by making simplifying assumptions. These assumptions allow us to gain important insights into how assets are priced without complicating the analysis. Once the basic relationship are established, we can relax the assumptions and estimate how our insights need to be altered. Some of these assumptions are constraining, whereas others are benign. And other assumptions affect only a particular asset, a set of assets, or only marginally affect the hypothesized relationship. Investors are risk-adverse, utility-maximizing rational individuals. Markets are frictionless, including no transactional costs and no taxes. Investor plans for some single holding period. Investors have homogeneous expectations or beliefs. All investors are finitely divisible. Investors are price takers. The main objective of these assumptions is to create a marginal investor who rationally chooses a mean variance efficient portfolio of a predictable fashion. We assume away any inefficiency in the market for both operational and informational perspectives. Although some of these assumptions may seem unrealistic, relaxing most of them will have only a minor influence on the model and its results. Moreover, the CAPM, with all its limitations and weaknesses, provides a benchmark for comparisons and for generating initial return estimates. The security market line in this subsection, we apply the CAPM to the pricing of securities. The security market line, this SML, is a graphical representation of the capital asset pricing model with beta, reflecting systematic risk on the x-axis and expected return on the y-axis. Using the same concept as the capital market line, the SML intersects the y-axis as the risk-free rate of return, and the slope of the line is the market risk of premium, RM minus RF. Recall that the capital market line, the CML, does not imply does not apply to all securities or assets, but only to portfolios on the efficient frontier. The efficient frontier gives optimal combinations of expected returns and total risk. In contrast, the security market line applies to any security, efficient or not. Total risk and systematic risk are equal only for efficient portfolios because those portfolios have not diversifiable risk remaining. Exhibit 7 is a graphical representation of CAPM, a security market line. As shown earlier in this reading, the beta of the market is 1. The x-axis, the market earns an expected return of RM. With the y-axis, using this line, it's possible to calculate the expected return of an asset. The next example illustrates the beta return calculations. Portfolio beta, as we stated above, the security market line applies to all securities, but what about a combination of securities such as a portfolio? Consider two securities, 1 and 2, with a weight of WI and security A and a balance of security 2. The return of the two securities are written as such. The last equation gives us the expression of the portfolio's expected return. Applications of CAPM. The CAPM offers powerful and intuitively appealing predictions about risk and relationship between risk and return. The CAPM is not only important for a theoretical perspective, but is also used extensively in practice. In this section, we will discuss some common applications of a model. When applying these tools to different scenarios, it is important to understand that CAPM and SML are functions that gives an indication of what the return in the market should be given a certain level of risk. The actual return may be quite different from the expected return. Applications of the CAPM includes estimates of expected return for capital budgeting, comparisons, and actual return of a portfolio or portfolio manager. With CAPM returns for performance appraisals and the analysis of alternative returns estimates and CAPM returns as the basis of security selection. The application and discussed more detail in this section, estimates and expected returns. Given assets systematic risk, the expected return can be calculated using the CAPM. Recall that the price of an asset is the sum of all future cash flows discounted at the required rate of return, where the discount rate or the required rate of return is commensurate with the asset's risk. The expected return of returns obtained from CAPM is normally the first estimates that investors use for valuing assets such as stocks, bonds, and real estate and other similar assets. The required rate of return for CAPM is also used for capital budgeting and determining the economic feasibility of projects. Again, recall that when computing the net present value of a project, investment and net revenues are considered cash flows and are discounted at the required rate of return. The required rate of return based on the portfolio's risk is calculated using CAPM. Because risk and return underlies almost all aspects of investment decision making, it is not surprising that the CAPM is used for estimating expected return in many such scenarios. Other examples include calculating the cost of capital for regulated companies by regulatory commissions and setting fair insurance premiums. The next example shows an application of CAPM to capital budgeting. Portfolio performance evaluation. Institutional money managers, pension fund managers, and mutual fund managers manage large amounts of money for other people. Are they doing a good job? How does their performance compare to a passively managed portfolio? That is one which the investors hold in the market portfolio. Evaluating the performance of a portfolio is of interest to all investors and money managers because active management costs significantly more than passive management. We expect active managers to perform better than passive managers, or at least cover the difference in expenses. For example, Fidelity's passive managed Spartan 500 index fund has an expense ratio of only 0.1%, whereas Fidelity's actively managed Contra fund has an expense ratio of 0.94%. Investors need a method for determining whether the manager the contract fund is worth the extra 0.84% in expenses. And its rating performance evaluation is based only on the CAPM. However, it's easy to extend the analysis to multifactorial models that may include industry or other specified factors. Four ratios are commonly used in the performance evaluation: Sharpe and 10-year ratios. Let me drink my water real fast. The M-squared ratio, the M-squared calculations, and the Jason's alpha. The measures of performance evaluation assumes that the benchmark market portfolio is the current portfolio. As a result, an error in the benchmark may cause the result to be misleading. For example, evaluating a real estate fund against the S&P 500 is incorrect because real estate has different characteristics than equity. In addition to errors in benchmarking, errors can occur in the measurement of risk and return of a market portfolio and the portfolio being evaluated. Finally, many estimates are based on historical data. Any projections based on such estimates assume that this level of performance will continue in the future. Security characteristic line, similar to SML, we can draw a security characteristic line, SCL, for security. SCL is a plot of axis return of the security on the axis return of the market. In Exhibit 11, Jason's alpha is the intercept of the beta in the slope. The equation of the line can be obtained by rearranging the terms in the expense for Jason's alpha and replacing the subscript of P and I. As an example, the SCL is drawn in Exhibit 11 using the manager's X portfolio from Exhibit 8. The security characteristic line can be also be estimated by regressing the axis of security returns from RI to RP to RP or to RI for RF minus RF on the excess market of RM minus RF. Okay, security selection will when discussing the CIPM, we assume that investors have homogeneous expectations and a rationale. Risk adverse, utility maximizing investors. With these assumptions, we were able to state that all investors assign the same value of all assets and therefore have the same optimal risky portfolio, which the market portfolio. In other words, we assume that there is a commonality among beliefs before an asset's future cash flow and the required rate of return. Given the required rate of return, we can discount the future cash flows of an asset to arrive at the current value or price, which is agreed upon by all or most investors. In this section, we introduce heterogeneity and belief of investors. Because investors are price takers, it is assumed that such a heterogeneity does not significantly affect the market price of an asset. The difference in belief can relate to future cash flows, the systematic risk of assets, or both. Because the current price of an asset is discounted value of the future cash flows, the difference in beliefs can result in an investor estimated price that is as different from the CAPM calculated price. The CAPM calculated price is the current market price because it reflects the belief of all other investors in the market. If the investor estimates the current price is higher or lower than the market price, the asset is considered undervalued or overvalued. Therefore, the CAPM is an effective tool for determining whether an asset is undervalued or overvalued and whether an investor should buy or sell the asset. Although portfolio performance evaluation is backward looking and security selection is forward looking, we can apply the concepts of portfolio evaluation to security selection. The best measure to apply the Jason's alpha because it uses systematic risk and is meaningful even on the absolute basis. A positive Jason alpha indicates a superior security, whereas a negative Jason's alpha indicates a security that is less likely to underperform the market when adjusted for risk. Another way for presenting the same information is with the security market line. Potential investors can plot a security's expected return and beta against the SML and use the relationship to decide whether the security is overvalued or undervalued. And the market exhibit 12 shows a number of securities along with SML. All securities that reflect the consensus market view are points directly on the SML. If a point representing the estimated returns of assets above the SML, the asset has a low level of risk relative to the amount of expected returns and would be a good choice for investment. In contrast, if the point representing a particular asset is below the SML, the stock is considered overvalued. Its returns does not compensate for the level of risk and should not be considered for investment. Of course, a short-term position in asset B can be taken if short selling is permitted. Constructing a portfolio based on a CAPM, investors should not hold a combination of risk-free assets and a market portfolio. The true market portfolio consists of large numbers of securities, and an investor will have to own all of them in order to be completely diversified, because owning an existing security is not practical. In this section, we will consider an alternative method to constructing a portfolio that may not require a large number of securities and will still be sufficiently diversified. Exhibit 13 shows the reduction in risk as we add more and more securities to the portfolio. As can be seen from the exhibit, much of the non-systematic risk can be diversified away with as few as 30 securities. Such securities, however, should be randomly selected and represent different asset classes for the portfolio to efficiently diversify risk. Otherwise, one may be better off using the index of S&P 500, for example. Let us begin constructing an optimal portfolio with a portfolio of securities like S&P 500. Although the S&P 500 is a portfolio of 500 securities, it is a good starting point because it is readily available as a single security for trading. In contrast, it represents only a large corporation that are traded on U.S. stock markets and therefore does not encompass the global market entirely, because S&P 500 is the base portfolio. However, we treat it as the market for the CAPM. Any security not included on the S&P 500 can be evaluated to determine whether it should be integrated into a portfolio. The decision is based on alpha I, the security, which is calculated using CAPM with this S&P 500 as the market portfolio. Note that security I may not be necessarily be priced incorrectly. For it to have a non-zero alpha I can be positively merely because it is not well correlated with S&P 500, and its return is sufficient for the amount of systematic risk it contains. For example, assume a new stock market ABC open to foreign investors only and is being considered for inclusion in the portfolio. We estimate ABC's model parameters relative to S&P 500 and find an alpha I of approximately 3%, of a beta I of 0.6% or 0.6. Because alpha is positive, ABC should be added to the portfolio. Securities of a significantly negative alpha I may be short sold to maximize risk-adjusted returns. For covariance, however, we will assume that negative positions are not permitted in the portfolio. In addition to the securities that are correctly priced but enter the portfolio because of their risk-return superiority, securities already in the portfolio S&P 500 may be undervalued or overvalued based on the investors' expectations that are incongruent with the market. Securities in the S&P 500 that are overvalued or negative to alpha I should be dropped from the S&P 500 portfolio. If it is possible to exclude individual securities and positions in the securities in the S&P 500 there are undervalued, positive alpha I should be increased. This brings us to the next question: what should the relative weight of securities in a portfolio be? And that's calculated with these equations. Beyond the capital assets and pricing models, in general, returns-generating models allow us to estimate an asset's returns given its characteristic, where the asset characteristic requires for estimating the returns are specified in the model. Estimating an asset return is important for investment decision-making. These models are also important as a benchmark for evaluating portfolios as securities or managers' performance, and the return generating model will briefly introduce in section 3.2.1. And one of these models, the capital asset pricing model, was discussed in detail in section 4. The purpose of this section is to make readers aware that although the CAPM is important is an important concept and model, the CAPM is not the only return generating model. In this section, we revisit and highlight the limitation of CAPM and preview return generating models that address some of the limitations of CAPM. Okay, so here's the limitations to these models. Okay, here's the summary. In this reading, we discussed the capital asset pricing model in detail and covered related topics such as the capital market line. This reading began with an interpretation of the CML, uses of the market portfolio as a passive management strategy, and leveraging the market portfolio to obtain a higher expected return. Next, we discussed systematic and non-systematic risk and why one should not expect to be compensated for taking on non-systematic risk. The discussion of systematic and non-systematic risk was followed by an introduction of beta and return-generating models. This broad topic was then broken down into a discussion of the CAPM, and more specifically, the relationship between beta and expected returns. The final section included applications of the CAPM to capital budgeting, the portfolio performance evaluation, and security selection. The highlights of this reading are as follows. The capital market lines is a special case of the capital allocation line, where the efficient portfolio is the market portfolio. Obtaining a unique optimal risky portfolio is not possible if investors are permitted to having heterogeneous beliefs, because such beliefs will result in heterogeneous asset prices. Investors can leverage their portfolios by borrowing money and investing in the market. Systematic risk is the risk that affects the entire market or economy, is not diversifiable. Non-systematic risk or is a local and can be diversified away by combining assets with low correlations. Beta risk or systematic risk is priced and earns a return, whereas non-systematic risk is not priced. The expected return of an asset depends on its beta or risk and can be computed as such using the CAPM. The security market lies in the implementation of the CAPM and applies to all securities, whereas they are not efficient or not. Expected returns from CAPM can be used for making capital budgeting decisions. Portfolios can be evaluated by several CAPM-based measures, such as the Sharpe ratio, the Trenner ratio, M-square, and the Jensen's alpha. The SML can assist in security selection and optimal portfolio construction. By successfully understanding the content of this reading, you should feel comfortable decomposing total variance into systematic and non-systematic variance, analyzing beta risk using CAPM, and evaluating portfolios and individual securities. Okay, so this is reading 40. I do hope my readings have been helpful. And remember, my show notes and my CFA Level 1 program curriculum notes are in the description below. You guys can go there and head down to Amazon to see my notes. And I hope my readings have been helpful. And we will be getting into Portfolio Management Part 2, Study Session 13, which encompasses these few readings in the next section. So I do hope my readings have been helpful. Go to my show notes, get my show notes, and I hope to see you guys next time. Goodbye.